So now that we have understood about goodwill and how it actually shows up in the balance sheet, the next question would come as that, like the other intangible assets like patents or agreements, we have seen earlier that these actually are amortized. So our definition of amortization was like depreciation for long-term assets. Amortization actually meant that you are expensing this cost associated with patents and agreements over a period of its useful life. So likewise, you have paid a premium and you have earned and you have actually had some goodwill on the balance sheet. So should it be amortized? So that is a very important question, because as per the accounting rules, it says that goodwill should not be amortized. Goodwill should not be amortized. Instead, it should be subject to something called impairment tests. Now, who does this impairment test and at what frequency? These are actually done by auditors who are experts in evaluating brands, and this is done annually. So, I mean, what happens is if the experts actually feel that there has been an impairment in terms of its goodwill, which will eventually mean that they have paid a higher price or a higher premium, this will lead to the reduction of goodwill and essentially on the balance sheet. So if your goodwill reduces on the balance sheet, there will also be a subsequent impact on the income statement, and this impact will be like a loss that will get reported due to the impairment or the reduction of goodwill. So let's look at how this actually flows in both the income statement and the balance sheets. Now this is the earlier balance sheet which we have looked at for the combination of A plus B while we used the purchase method of accounting. So we saw that the goodwill was 500. So let's say after 1 year there has been an impairment of goodwill to an extent of $100. So how will this get reflected in the balance sheet as well as in the income statement? So if there is an impairment like this, what will happen is on the asset side, instead of this 500, this will become 400. So let's look at the impact. This will be the incremental impact that we are going to discuss. So your goodwill is actually now will reduce by 100. So this will actually show an amount which is equal to 400 here. So goodwill gets reduced by 100. So there must be some corresponding entity on the liability side that must get reduced by 100 so that your total assets are equal to the total liabilities. So this reduction in liabilities actually come from the income statement. Now we know this golden rule that the net income from the income statement is linked to the shareholders equity section in the form of retained earnings. So your retained earnings will actually get reduced by 100 by showing this impairment as an expense on the income statement. So what happens is in the income statement you'll report an expense which will be called as impairment, and at the net income level you will see that there is a loss of 100 because of this, and this 100 loss will actually flow here in the liabilities side. So this is the incremental impact of the impairment. Impairments are reported on the income statement.